What's up, Gould Miners? Today we welcome Michael Quan to the program. Michael is a renowned real estate investor and author of The Fire Planner, which helps readers chart out their financially independent retire early journey. In this episode, Michael and I cover a wide breadth of topics, starting with Michael's own financial independence journey that allowed him to retire at the age of 36, and how he would recommend any average W-2 employee approach their own FIRE journey. Later on in the episode, Michael goes over his entire real estate investing history, starting with direct investments in short-term rentals that eventually graduated into becoming a limited partner in over 30 different real estate syndications. Michael then goes over in detail the top 3 things that he looks for when vetting real estate syndication opportunities. And finally, we conclude the episode with talking about the current state of the market and how he's adjusted his strategy to take advantage of what's coming up in this next cycle. Michael has spent his fair share of time both on the active and passive side of the investment worlds. So Michael truly has some amazing knowledge to share with you, regardless of what side of the spectrum you're on. So without further ado, everyone, let's welcome to the show, Michael Quan.
The Gould Mine Podcast.
Michael, welcome to the Gould Mine.
What's up,
Danny? What's up, man? All right. Well, we're ready to rock and roll here. You've got quite a few things on your resume, Michael, and talk to me about the FIRE approach, the FIRE planner, and kind of how you got started with all of that, and let's start there.
Absolutely. So, listeners, for those of you that don't know what FIRE stands for, it's an acronym in the personal finance space, and it stands for Financial Independence, Retire Early. And I had the great blessing of being able to write a book called The Fire Planner with Simon & Schuster. And it's really a roadmap to help you to build your passive income so that you can make work optional. And, I was very blessed in my career to be able to build a company in my 20s and then exit that in my 30s and then use that to purchase cash flowing real estate.
Mm-hmm. Mm-hmm. That's awesome, man. And not everyone has a massive exit. Right. And then can take that money and then put it into cash flowing assets. But for someone that's maybe on the, let's just call it the 9-to-5 W-2 grind, they're maybe, able to, let's just call it after taxes and everything, maybe stash away 50 to 100 grand a year, right? Or have 50 to 100. And that's actually pretty good, right?
That is pretty good.
50 to 100,000, expendable income at the end of the year. What would your advice be to someone like that?
Yeah, well, and really first, let me quickly remind, because sometimes when people hear that, I started a tech company and then I exited, they're like, oh, wow, you had all this money that you could just throw into real estate and create cash flow off of terrible deals, right? That actually wasn't the case. So I created a tech company, but it was more service-based. So we were going in doing IT infrastructure. And so that doesn't carry the same multiple as a SaaS app or something like that. Yeah. So when I exited, right, it's not like that I had gobs and gobs of money just to throw at real estate. I still had to go in and learn how to actually find deals that cash flowed. And in retrospect, even as the owner of the business, I wasn't paying myself excessively. I was in there paying myself a normal 9-to-5 salary. So I can really relate to you listeners that are on that traditional path of 9-to-5. Now, what you do with that money that you take in is really the key. And I think you said it great, Danny, is that, if you're able to stash away some, 50 to 100 grand is great, but there's some people that can do less, they could do more. But what it really comes down to is, what are you doing with that money, right? Are you putting it into savings? If you are, that's a great first step. But of course, you're on Daddy's podcast. You want to know how to build that. You want to know how to build passive income. And of course, real estate is a phenomenal way. The other 2 ways that I talk about in my book are to use entrepreneurship as a vehicle, as well as the other option is to be very aggressive with your savings and really get those expenses down really low. Now, some people don't necessarily like that because it feels like they're, kind of scrimping on things. I actually don't. That's not my favorite part of it. But the truth is, you do have to do a certain amount of that. You have to have a certain amount that you're saving. Otherwise, you're never going to get ahead. You can make $10 million a year. And if you spend 11 million or 10 million, you're going to be at zero or negative, right? So we want to be intelligent with that ratio, right? And be intentional is my point.
Yeah. So let's talk about, so financial independence, retire early. I think there's a lot of retire early folks out in this space now. You know, like, you know, on LinkedIn, I swear, man, I see like at least one I retired early post a day now, you know, so explain to me like your approach, right? Like what is your approach and what is the definition of retiring early? Are we saying like, you know, under the age of 40, under the age of 50? Is it simply just like retiring at any point before the average age of, I think, what is it, like 65, say 70? 65, so like,
yeah.
You know, what is the definition of early and what is the definition of retirement, right? Like what you see what I'm saying?
Great question, Danny. You know, retirement early is a funny concept because a lot of people get up on arms if you tell them that you're retired. And then they see you working on some sort of project. They get, oh my gosh, she's not retired. And I'm going to tell you straight up, once you have the ability to retire, the financial independence, once you have enough passive income so you don't have to work for those expenses, right? That's that point where you have the option where you get to retire early. So I always tell people that the important part of FIRE is the financial independence. The retire early is more of a psychological marker. And I got to tell you, Danny, you know, this happens time and again. You'll see it with, you know, the greatest basketball players, football players, right? They retire and then they had no more sense of purpose, right? So for me, I was in entrepreneurship and all of a sudden I didn't have a sense of purpose anymore. So I had to go find it in other places. And so I had the great fortune though, at this point to explore, you know, dozens of different things, selling things at Amazon, financial coaching, writing a book, learning how to public speak, all these crazy things that I got to do because I got to that financial independence first. So what I like to tell people is that when you're firing, it's really about building that financial independence first. And then the retire early, it's flexible. I took a year off and I just went out and I did whatever I wanted. I went fishing in Panama. I did some cool things on my bucket list. As a kid, I wanted to blow up a car. So I took a special effects class in Florida and blew up a car. And
oh my God.
So you get to do those fun things. But the truth is that as humans, we always have this drive to grow and expand. Sure. And what happens is that once we realize that, we want to go back and work on the things that are important to us. And that's exactly what happened to me.
Yeah, that's awesome, man. Well, I think as humans, we're made to create, right? So it's, so I totally get it. It's like, you know, it's also, you see these guys who they retire and then like they're like dead within a year or two, right? And so you really do have to stay in motion. And I understand what you mean. Retirement is not necessarily a phase of life. Like now I'm in retirement. It's like now mentally, I'm no longer burdened by the idea of like, I need to wake up tomorrow to work. I can chill if I want to. I don't have, and a lot of, I mean, that's super liberating when you think about it, right? Because, and in fact, I feel like some people maybe become the most dangerous versions of themselves, right? Once they reach that phase, because they're no longer a slave to the psychological burden of like having to work for a paycheck. So I could see, I can definitely see the advantage to that. So, okay. Financial independence, retiring early. And what are we talking about? Like under the age of 40, under the age of 50, under the age of 60? Like what's early?
I think exactly what you said earlier. Anything below the traditional 65 type of number. But, typically in the FIRE space, you'll see people, sometimes in their 20s, that's pretty extreme, but 30s, 40s, 50s is kind of that general range that people are targeting.
Yeah. And, Are there specific investment approaches or strategies that you recommend so we'll start there. Let's start there because I have some follow-up questions.
That's a great question. For myself, I'm pretty broadly diversified. So even when I had my first job out of college, and I only worked there for a year and a half before I started my own company, I started investing right away. I did my Roth IRA. I did my 401k match. And, I was lucky that I had parents that really drilled home that idea that to save and invest early and often. And the great thing is that if you do this early and you create a habit of it, it doesn't seem like you're really having to cut any corners. It just becomes a way of life. And so I like to always tell, younger people, if you just really build that in as an assumption from the get-go, or even if you get a bonus, right? I'm not saying you shouldn't enjoy some of it. You should enjoy some of it, but also make sure to take time to invest a portion of that so you can set those seeds, so you can build the compound interest vehicles early and often. So, definitely first and foremost is you want to get into that saving, investing mindset.
Yep.
And then from there, the two vehicles that I really love, of course, is real estate and then also entrepreneurship. I think those are phenomenal ways. Plus, I guess investing in stocks and equities is another way.
When you say entrepreneurship, you mean like investing in your own businesses or investing in other people's businesses, like angel investing? What do you mean?
Yeah, great question. Initially, I would say it's investing, to be honest, in yourself. In yourself as you're the CEO of your own self, right? You are a business, whether you're going out to the market as a new college grad or you've already been in the industry, you have a career path. You're your own business, right? And so being able to operate yourself as a business, knowing that you are a finite resource, that you can create income, you can create, that you have expenses, right? And you want to know that cash flow, but then going a step further, right? You can do it a couple different ways. You can either do it moonlighting on the side. You can do things outside of your current job or career, or you can create something on the side, sell it online, right? So there's all these different paths that you can, dip your toes into entrepreneurship.
Yep.
You can also, burn the boats and go full force and jump in like I did. I don't recommend that. What happened with me, Danny, is that I was actually working for a tech company just out of college during the .com phase. And so this was a time when the internet was just first coming out. And so there's money being thrown around the left and right. And so it was a really great time for me to graduate in that sense. But within a year and a half, the unthinkable happened. We had 9/11, right? So as soon as the towers went down, so did the U.S. economy. And the company that I was working for started to implode. We had to shut down our office in New York, Los Angeles, and in San Diego, where I live. We reduced the staff by half. So I had a very, hard decision on what to do. Do I stay put or do I go out and do my own thing? And, ultimately I decided, I'm not going to just sit in fear and freeze. I'm going to go take my own destiny in my own hands and take action. So I started a company with a couple other friends from that company.
I love that, man. I love that. So obviously you had your run and how you built up your company. When did you sell it and when did you get into real estate investing?
Yeah, so I ran the company for about a decade or so before we ended up selling it. And so I really started getting interested towards the end of my entrepreneurship journey with this company with real estate, because I realized that even if I exited the company, right, and I got a chunk of cash, then, if I start drawing down on that, then it's not going to really serve me. It's just going to go away eventually, right? So I was like, well, how do I create cash flow? And so I was fortunate that I had some uncles that had done very well in real estate. And so I really asked them some questions. I read Rich Dad, Poor Dad. I read different books by different people that talked about different streams of passive income. I'm like, all right, I'm all in. But I didn't know anything about real estate. I knew about entrepreneurship. I didn't know anything about real estate. And so I just put my head down and I studied and I listened. I went to conferences. Back then, there's no podcast. There was barely Audible books, right? So back then, it was just reading nonstop, reading, going to these different conferences. And, I got to tell you, I was probably one of the scaredest real estate investors you would ever find. It took me 4 years, Danny, I kid you not, 4 years before I made my first offer because I was just terrified. I was in analysis
4 years. Really?
4 years.
Wow.
Yeah.
Wow.
Because I was just so in analysis paralysis, not wanting to get it wrong.
Wow. That's crazy, man. Yeah.
What happened though is I eventually got, sick of my own analysis paralysis, and I went out there and I started making offers. And I got to tell you, the first, 5 didn't go anywhere because I wanted to make sure it was the perfect deal. So I ran all my analysis, double checked everything. And then by the time I finally made the offer with the agent, it was gone. They're like, yeah, they've got like 2 contingent offers in as well. So you're a little late. Started to accelerate that process and really get over that fear. And then I realized, you know what? There's an inspection contingency. I'm like, what's an inspection contingency? I was like, oh, you don't actually have to buy the place if it's like, messed up here or there. You can ask for different discounts. I'm like, I didn't know that was there. Yeah. And finally made my first investment in 2000. 2010, actually, 2010. So it was a good time to make the investment.
Great time to get in the
Didn't
market.
know it at the time, okay? Didn't know at the time. This was my 12th offer, finally got accepted. And I was like, yes, I'm a real estate investor, right? So I was like all thrilled, telling people I'm a real estate investor. I go to list a property, and I kid you not, maybe a day or two after the property was listed, I think I had it on like, apartments.com and like, I don't know, Craigslist and wherever else, right? I get an email.
Listed for rent.
Listed for rent, yes. I get an email from the HOA, says, it says rentals are not allowed in our community in bold letters. And then I'm like, what are you talking about? And they're like, see attached HOA disclosure. And then I'm like reading through this thing and I'm like, are you kidding me? There was an HOA exclusion that I couldn't rent this property for 99 years, except to my mother or direct siblings. So my first income property, Danny, had zero income.
Oh, man.
But the reason why I tell you this story is that,
that's so funny.
In anything in life, whether it's entrepreneurship, whether it's you going out, taking action, right? Your result's not guaranteed. You're going to get a result. The result's not guaranteed, right? But the question is, what are you going to do with it after that? Yeah. And so, after calling myself some terrible names, I got off my butt and I was like, okay, well, how else can I look at this? And I realized that, okay, well, this is just a very expensive lesson, right? And if I don't do anything with this is going to be a very expensive lesson that has no value whatsoever. And so I picked myself back up and I ended up 2 months later purchasing a house across the street, and same exact numbers, same exact fundamentals. And that, properties pay me, an infinite return now because I only put in like, I don't know, let's just say 15 grand or whatever, right? And it's paid back hundreds of thousands of dollars and I still have the cash flow. So now the return's infinite. But point being again, is that for our listeners that are in the process of learning how to invest, trying to find that point of financial independence, it's a little messy along the way.
Yeah. Well, it's, bro, that's really unfortunate. Not gonna lie. I mean, you're getting into investing. Well, and I think this is maybe this is a condo. I'm assuming like condominium or a townhouse.
No, actually, it was a 3-bedroom, 2-bath house. But yes, it was in a HOA community. Even though it didn't matter.
Yeah. Well, and this is why I highly advise all, people that want to get into, direct investments like that is never buy inside of an HOA, right? Not only do you have all these rules and stuff, right? But like the HOA, there is zero return on that money that you're, at least with interest and with the mortgage, you're paying down principal.
Mm-hmm.
But that's money that evaporates. It goes up into smoke, right? So you're never going to see that money that you paid at the HOA ever again. That's interesting, Matt. What happened with that investment? Did you sell it? Did you?
So it became a second home, a vacation home, a very expensive vacation home. It remained unfurnished for like 2 years.
Oh man!
But thankfully, because I bought it in 2010, by 2012 I was able to recover my losses and just break even and exit it. So I'm fortunate that I did buy it at the right time.
Yeah, 100%. No, that's a great time to get into it. So, all right. So then walk me through your approach, right? Like early 2010s all the way through, the COVID year. What did that, because, the market was appreciating that whole time. Were you just buying rental properties, buying and holding, doing BRRRRs? Were you flipping? Were you wholesaling? Like what were you doing to kind of build that portfolio?
Yeah. For me, I'm kind of lazy. And maybe it's just like efficiency. But for me, I like to buy things that were pretty much turnkey. So I would go out and I would just scour, Zillow. I would look at, I was on a couple different lists of real estate owned, things owned by the banks. And so I'd get lists of different things coming in. And so I bought a few bank owned properties, one just straight off the MLS, I think. And again, because it was a great time, things worked out. And so I just, sat on them and held them for the most part. Might have gotten one, got rid of one here and there, but, I bought a few. I wish I bought obviously 20 at the time. But after that, my family started growing. So I wasn't as actively looking for my own deals at that point. And so what happened is I then shifted more into syndications and really working with other investors that were doing all the legwork. And I was just kind of providing the capital. Yeah. And, knock on wood, I've been very fortunate in that approach thus far. And, just for the listeners that are listening right now, that's one area of real estate investing that people get excited about. And I think you should, syndications where you're partnering with other real estate investors to take down, big apartments, or they're doing development projects that make a lot of sense. It's great that you can partner with them because sometimes you can, remove yourself from a lot of the additional, overhead as an investor. But there could be some dangers to that as well. So my point being is that you still have to do your due diligence. You still have to go through, understand the numbers. You have to know who you're partnering with. And I've been fortunate that, people that I partner with, probably 30, 40 different deals now over the last 20 years or so. Knock on wood, I haven't been burned yet. That's not to say that I won't. That's pretty rare. Part of it I will attribute to luck probably. But I think a lot of it also has to do with, being very diligent on what you're doing and when you're doing it. Yeah.
When going through the diligence process on a syndication, what specifically, what are you looking for? What are the things that you really focus on? Because, honestly, there's a checklist of a million things that you could look at, right? But you even though you're Mr. Fire, right, you've got plenty of time, right? Unlike most people are working, right? And they've got, they're making lots of money, but they're making lots of money because they're spending a lot of time making that money. And so they don't have the time to do a ton of due diligence. So if you had to boil it down to top 3 or 5 things that you kind of look for and vet, what would those things be?
Yeah, I'm really looking for, first and foremost, can I trust the partner? Is it someone that has a track record of deals that they've done, and what's the experience that other investors have had with them? So sometimes I'll literally go out and I'll talk to other investors that have been in other deals with them just to understand what their overall experience has been, because that'll tell you a ton, right? And I learned that probably through entrepreneurship. When you hire someone, you want to go out and talk to the former employer. You want to understand how their work ethic was. So same thing with, a syndication. You want to know who the GPs are and what they're bringing to the table. Secondly, numbers. It's got to come down to the numbers. At the end of the day, we want to know what the numbers are. And so with syndications, it's structured so many different ways. So you have to really start to look at lots of deals to understand and be able to compare what makes one deal better number-wise than another deal. And so being able to look and say, okay, here's the preferred return, here's the equity multiplier forecast, here's the, specific property, those are all specific things. And one of the things that I liked was finding GPs or finding syndicators that were specifically targeting individual properties. Now, sometimes syndicators will get so large that they start creating these funds and they're starting to take down multiple properties. And again, there's a time and place for that. But for me, I didn't necessarily like that because I couldn't analyze, things that they were going to just buy on their own later on. And I'm like, you know what? Right. I can't, as a, investor, really vet that myself. Then I'm really kind of investing in them. And again, I'm sure there's people that are good at that. But for me, I still want to know my numbers on a specific deal. So I really try to concentrate on syndicators that are specifically targeting one individual property, one apartment, one commercial property, whatever it may be. I'll tell you, Daddy, there was one time that was incredible. And these times are gone now. But there was a time where there was these syndicators that were going into California, into Beverly Hills. And they were buying up these old houses that, were kind of run down, but they were huge. And they would knock them down and put up these crazy, double the size houses. Yeah. And because the economy was on fire at the time, they were selling it for 4X. So I was literally giving them money. And within a year, we had 25%, 30% internal rate of returns. It was insane. And again, I tell you this because you asked about the 3 different pieces, right? So understanding who the GPs are, understanding what you're investing in and understanding the numbers, right? It's a combination of, I think, those three things that really move the needle.
Yeah.
And then at the same time, sometimes the devil's in the detail. So you also want to make sure that you're not being dumb like I was on my first deal, right? Not reading through the HOA disclosures, the CCRs, whatever it was, right? Because there's been a lot of times I've actually not invested in things because I found certain things that didn't quite jive.
Yeah.
And the last thing I'll say, Danny, is that in this day and age, what's really incredible is that now we can use AI to really do a lot of that legwork for us to really dig out some of those finer details. And it saves a ton of time. So now I actually use it to, compare deals side by side. And it's like, oh, I can see that really quickly, right? And I know exactly what I'm signing. Sometimes before, in the past, I'll be honest, I got to a point where like, all right, I'm just signing this thing, right?
Screw this.
So that's where the luck comes in, right?
I'm on page 70. I can't take this anymore. Yeah.
It's like 300 pages sometimes. It's nuts.
Yeah, those PPMs can be large. Well, and it's funny that you say that because, I mean, that is one of the unique advantages of having, like a really solid AI tool, like, ChatGPT. I've had it parse through legal documents before. Like, we had these lender disclosures and I was like, act as my attorney, tell me like everything that I need to know to like look through, anything that is not in my best interest, right? Like, or things that you would look out for. So you're kind of instructing it to kind of call out all the BS and there are a few line items that it calls out like specifically. And I'm like, okay, so then you can start to, that is fascinating. I actually have not heard, I haven't talked to an LP yet that has used AI like that. That is very interesting, man. That's very interesting. I'm excited to share that with the rest of my community. I think that they'll find some value in that. That's really fascinating. I love it. Okay. So what asset classes are you invested in right now, Michael? As an LP, are you, you mentioned apartments. It's, you mentioned a couple other, commercial asset classes. So, kind of walk me through the different asset classes.
Yeah. In terms of the partnerships on the syndication side, typically targeting apartments. So I'm in some deals right now where we're in Tennessee. So like 300 unit types of apartments. And so, very simple types of, strategies going in. By actually the one that we just bought recently this last year was because some of the other syndicators in the years past got a little too aggressive. And then when the interest rates popped up, they lost all of their footing. And so we went in and basically bought, for pennies on the dollar. So I'm always looking for those deals, right, that have that built-in equity up front.
Sure.
And, but aside from that, going in, fixing up the units and then making sure that we can raise the rents and then typically exiting within a few years is ideal. But typically, apartments in, Tennessee, Texas, Florida, I forget where else, but generally, like some of the Sun Belt. Yeah. Nice and simple, nice and, to be honest, boring. I love boring because boring pays, I think. With the exception of, I told you the Beverly Hills deals that came through. Those were a little bit more exciting.
That didn't sound too boring.
That was exciting, but that kind of came and went quickly. But also I do, have some long terms that I ended up turning into short terms. And those have been great. Those are out in Las Vegas. And technically, I don't know how long those are going to be able to run because in Las Vegas, they started introducing a lot of short-term restrictions. And so I'm kind of still surfing on, some gray areas here and there. Eventually it might get shut down. So I'd probably move that more to midterm, which will still probably pay more than, traditional long-term. But it's been interesting exploring these different, strategies and moving just from a traditional long-term and finding these little pockets of opportunity along the way.
Well, Vegas seems, I don't know. I know the market semi well, right? Just because I have an interest in building or developing there in the future. But, from a midterm rental standpoint, it seems to me like there are, some good demand drivers in that market for midterm rentals. Because, for short term, obviously you got your transient activity and Vegas has no shortage of that. But from a midterm rental perspective, you know, you look at hospitals. Yeah, it's got hospitals in the area. You've got universities, right? So you've got, you know, some of these demand drivers that kind of feed into the midterm rental market. So I think that your investments are going to be fine there, man. Just based, you know, yeah, I can't tell you for sure, but just, you know, overall, like just base level knowledge of foundational level knowledge of midterm rentals and demand drivers in that market, I think you're going to be fine.
I'm glad to hear that.
Yeah.
Yeah. And I'll be fine. You know, I think one of the things also, just to kind of let your listeners know, is part of my investment journey, and everyone has a different way of approaching things, right? Yeah. I'm a little bit more conservative in that. Like over time, as I started to get more cash flow, I decided at a certain point to pay off everything, right? So my cash flow is free and clear. Now I don't get the leverage anymore, right?
Yeah.
But I do have that security that now I can just kind of play with it. All right, long term is going to definitely give me a certain amount of cash flow, but let's see what happens when we tweak it to short term. And then it, you know, it definitely popped. It tripled, I think, at one point, and then it's adjusting back down a little bit, right, depending on the market. Yeah. And like you said, midterm is probably going to be somewhere in the middle. Yeah. But again, as you're building your portfolio out, listeners, you know, you just really want to be aware and intentional about kind of what your outcomes that you're trying to create. Are you trying to build a cash flow? Are you looking for an equity play? What is it? Are you looking for the combination thereof? And just being intentional with what your strategy is. And then, you know, life will kind of kick you a little bit occasionally and you'll get what you get, right?
Yeah. Yeah, exactly. Well, but it's good to have a strategy. And actually, that was going to be my next question anyway. So you kind of beat me to it. But and I have a feeling I already know what your answer is going to be. But when you're looking at these, you know, syndication deals now, are you? I take it you're primarily investing for cash flow now, opposed to like equity growth. Is that? Yeah,
it's a little bit of combination of both, but it's the cash flow first and foremost. Yeah, it's always, I think, been that. You know, I've definitely been fortunate that equity has you know, played a nice factor over the years. But, you know, one of the best things that I did was, you know, read, you know, stuff from whatever, let's say Robert Kiyosaki and everyone in between, right? That really talked about focusing on the cash flow first. I think that's really served me over the long term. And so just because I got fixated on that, I think it's served me well over my years.
So, and this is, you know, I'm here to learn too, right? But like you're investing in multifamily syndications for cash flow. It seems I don't know a lot of people that are getting really great cash flow returns right now in multifamily. So I'm curious, you know, like what is it that's made those investments different than the average? Because, you know, with the rates where they're at right now, right? And even if you were invested before 2020 or so, like a lot of those notes have come due. So that either the rates have readjusted back up or they've had to refinance into different debt products. So I'm just kind of curious now that we're in 2025, how you're seeing good cash flows come out of your multifamily investments.
Yeah. Valid question. Well, I should disclose that I haven't been investing in those for actively. I mean, I'm always looking at stuff, right? But you know, the last deal that I told you about, right, is because people got in trouble because they were out there buying at the wrong time. I sat out for like a good 2 or 3 years and I readjusted my investment focus in other areas. So the other thing, just to kind of throw out there, is that, you know, even though I'm looking for cash flow, right, it doesn't mean that it's always necessarily in, of course, I mean, yes, I'm always looking for cash flow as a real estate investor, but I'm looking for cash flow in other areas, right? Whether it's, you know, in the equity markets, outside of different things. There was a period of time when I was doing a bunch of crypto stuff, right? And I was actually learning out, you know, crypto and getting like, you know, 20, 30% returns, right? Now, did that last? No. But there was these periods of time, right, where you can kind of go in, and if you're not too greedy, you can kind of get in and out. If you're too greedy, you get burned, I feel. And so I guess my point for the listeners is that there's always kind of these markets, right? Real estate is obviously one market. That's one vehicle of growth. You've got the equities markets, the stocks. And then now you've all these alternatives with, you know, Bitcoin and all these other types of investments. And again, I feel like that's a little bit more risky, but it's still something to think about, right? And I don't put all my stuff in there. I have a small portion, but guess what? If you have a small portion into something that can hit a home run and you hit like, a triple, then all of a sudden, that makes up for the loss of cash flow that you would have had otherwise, put into a deal that was, potentially shaky. And so, as someone that's always kind of looking at the economics and economic forecast, I want to try to get somewhere before we're there. Now, does that always happen? Absolutely not. But I think real estate, at least, is a slower cycle. And so it lags a lot of the other markets. So because I'm paying attention to the other markets, I feel like a lot of times real estate, you can strategically position yourself or not take action in the times when it doesn't make sense. And that's probably why I didn't get burned in some of the last few years, is because I stopped at a certain point when I'm like, whoa, wait a second, right? Because at that point, some of the pro formas on the prospectuses that are showing the cash flow was significantly down, right? And the equity multiplier was like kind of out of whack. They thought things were going to happen. I'm like, no way, good luck, right? I can see where this is going, right? And so I'm like, okay, no, not doing
razor thin margins and like massive exits. Yeah, exactly
that. So that should ring the alarm bells. Yeah.
Well, honestly, man, good for you that you could kind of spot that trend, because to be honest with you, like not everyone was that smart. There's a lot of people that kept on investing during that time. So it sounds like you had the wherewithal, the foresight, right, to kind of see the writing on the wall. You took a few years to kind of recalibrate, let the dust settle. So moving into the latter half of this decade now, right, 2025 and beyond, what is Michael Quan's like updated investment approach for like the latter half of this decade, given all of the, the turbulence and the uncertainty and the this and the that, right? We're heading into kind of some choppy waters. What is your approach? What's your strategy going to look like over these next 5 years?
Yeah, great question. And really quick, I just want to say that, it's not that I'm that smart, right? But I listen to smart people. And I think, the people out there like Ray Dalio, the people that are really, looking at the macroeconomic environment, and then you kind of extrapolate, you can kind of get a general sense. But again, some of it's going to happen just due to luck. But what I will say is I think going forward is that I'm kind of excited, right? I see some of this turbulence. So I'll give you an example. And this isn't necessarily real estate, but literally this last week, there was a dip in the market because Trump said that, hey, I'm going to try to fire, Jerome Powell, the Fed chair. And so the whole market like tanked like 1,000 points in that day.
Oh, God.
But here's the thing. I was already planning to make a trade for this portfolio of like 6 figures or more. And I'm like, I was just waiting for a down day. And I'm like, here we go. There's the down day. And so I built that position in that day on it was a Tuesday. I don't know what day it was, but whatever day it was, right? And then literally the next day comes back, and then Trump softens his blow, and he's like, I'm not gonna fire him, right? And then we go back up like 800 points. And so again, I tell you this story not because I'm so smart, but because I had already had a general plan of dollar cost averaging into the market, right? So I was already going to make this play. I was going to hold it for the long term. But since I was going to hold it for the long term, and since I kind of knew that we're in a period of volatility, I may as well take advantage, right? If we have a down day. And my point is that I think as an investor, as an entrepreneur, as someone that, is trying to find financial independence, if you can put yourself in a position of almost like a no-lose situation or minimize risk on one side and have upside risk over here, I think people call it asymmetric risk to return. Where you have this, much higher risk relative to the amount of risk that you're putting up. If you can find those pockets, then I think that's the best position to kind of be in. And so going forward, just to answer your question, that's kind of how I live my life now, so to speak, right? When I'm doing the things that matter to me, for example, like personal development matters to me, learning how to speak and go talk to different companies and whatever. That's totally unrelated, right? But I'm still paying attention. And so when those opportunities pop up, I go to work. And then when it goes away, I exit, and then I focus on things that don't necessarily pay cash flow or do anything, right? But it fulfills me.
You're right.
So I guess what I want to get at really quickly, Danny, and I'll let you get to your next question, is that listeners, what are you building all of this for? Right? I mean, the freedom, the financial independence to retire early. I finally figured out, Danny, when I finally had this freedom, that it was an opportunity to grow more and basically create impact. And what I really want you listeners to understand is that as you start building your portfolio, being able to spend that time with your family and make use of some of this cash flow that comes in, being able to enjoy it now, I think is one of the best things that I've done over my career.
Awesome, man. Yeah, no, that's great. So just out of curiosity, right? Because you talked about, you kind of threw in a whole nother thing. Are you doing like a lot of day trading right now? Is that what I'm hearing?
No, absolutely not.
Oh,
no,
okay.
so it was a quarterly trade that basically all our costs is averaged it into a number of index funds, as well as a small portion of Bitcoin fund or whatnot. Yeah. But this is happening quarterly, regardless of what the market does or not. But because that was happening and because we had the volatility, then, did I know for a fact that it was going to go up the next day? No, but I had a pretty good idea that, the market goes crazy when Trump says something.
You're at least buying it at a discount, right?
Yeah.
At a relative discount. Yeah. Yeah. That's awesome, man. So in terms of the overall strategy for the next 5 years, it sounds like you're parking some money in the index, right? So you've got some stuff going on there. You've got a little bit in crypto. Sounds like you've got a lot of money invested still into some syndications, right? So you're like an active LP in quite a few syndications right now as well.
A handful. Some of them are actually more.
Have those already phased out? Have you
Most
already?
of them have already phased out. Yeah.
Oh,
so
okay,
the only one right now is that one that I told you about in Tennessee. The other ones the other properties that I have are kind of owned, or I have some family owned property as well. We have some apartments in California, some commercial property, but those are, separate. And those again are paid off. So I do feel fortunate, right? I'm not really affected by the interest rates, but what I am paying attention to is some of this volatility, right? So if we see a flip, right, then I'm going to start getting busy, right? Because I'm going to remember back to 2010 when I bought my few properties, right? When I wanted to buy 30 of those, right? If I see the opportunity come again, Warren Buffett always likes to say, right, be greedy when others are fearful and fearful when others are greedy. And so
100%.
Really taking action on that idea is I think that's my strategy going forward, to be honest.
Yeah. So you're sitting around patiently waiting for more distress to kind of pop its head up.
Yeah.
Yeah. Love it.
Yeah.
Love it. Well, there's going to be, they keep saying, man, they keep saying it's coming. And it's been like the last 2 years, really, last 2 years, we say, oh, there's blood in the water. It's coming. And we're like, one of my mentors says it's the delay and pray, part of the cycle, right? Where the lenders are kind of playing this delay and pray game with the operators but we'll see. There's, we'll see, man. It's an interesting time for sure. Very, very interesting time. Very, very interesting time. Well, we're coming up on time here, Michael, and I want to be respectful of your time. There were a couple like last minute questions here that I had here. You have like a 25X rule. Can you tell me more about that? I'm kind of curious about that.
25X rule. Where did you find that? Because that doesn't necessarily ring a bell.
I don't know. I have it in my notes here. Like she's you ask about 25X rule for FI benchmarks. But
got it. Yeah. Okay. Yeah. Sorry. I know what you're talking about now. Okay. So we're going back to the idea of FIRE. So here's what that means. People always ask, how do I know when I'm financially independent? How do I know when I can retire early? And so there's a general kind of rule of thumb that you can take. And that's to basically take your annual expenses. And let's just say, for argument's sake, you spend $100,000, right?
Yep.
You can 25X that and say, all right, well, if I have 25 times that, then, and it's invested in the market and I'm earning dividends and whatnot, then that will be the amount that I need to basically exit and not have to basically work another day in my life, so to speak.
Makes sense.
And this is built off of this idea of what's called the 4% rule. So that you have a certain portfolio in the equity markets, your stocks, right? And that you're able to draw down from that over time and not, run out of money. So that's the idea there.
Gotcha. So 25X is like and that makes sense, right? Because that assumes like a 4% dividend per year, right? Or 4% annual kind of like cash flow on that investment. But to be honest with you, that's pretty low, right? Like 4%. There's like a lot of debt funds out there that you could invest into for like 8 to 12% yearly. And that's why I was asking about the multifamily, because I was like, man, I doubt he's making 8 to 12%, 8 to 12, because there's a lot of debt funds out there that are, but the difference is you're not making any appreciation on that money either, right? So there's no appreciation play. It's just straight cash flow, and you're, the end of whatever the term is, you're out. So yeah, multifamily is an interesting space right now, man. I think that there's, before we wrap up, actually, what would you say to this? Because certainly I feel it, that it's a bit of like, I guess like the multifamily market has now gotten to a saturation point, right? Where there's like a lot of players in there. And everyone graduated from single families to multifamily like all at once. And so now we've got this like massive, right? So would you agree with that?
Yeah, absolutely.
Yeah.
And back to kind of what you were saying before is, I may not look at it, but I've been around for a while, right? So I'm nearing like 50. So I've seen cycles, right?
Yeah.
And I've seen these periods, right, of dips, right? And so, like you said, even though, in the past few years, it's like, oh, it's coming. Statistically, it is going to come. And when it comes, we're going to know when it comes. And I'm going to know when it's going to come. And I'm going to be there kind of just, taking my free pickings, right?
Yeah.
And so I guess my point is that, do we know when it's going to come? No. Do you know how it's going to come? No. But it will come. And so if you're positioned well and you have some dry powder, some cash on the side, or if you're ready to go, I think those are the people that are making a killing.
Mm-hmm. Mm-hmm. Yeah, 100%. And it sounds like you're not so directly saying that you've got some dry powder on the sidelines waiting to deploy too. So I'm interested to see.
I got a little dry powder.
Yeah, I got a sense.
A little dry powder.
Yeah. That's awesome, man. No, that's great. Well, Michael, you've been awesome, man. This has been definitely a very valuable episode. Learned a lot from it. But in traditional Gould Mine fashion, my friend, we're going to have you leave the audience with one final Gould nugget. Take it away.
Thanks, Danny. First and foremost, thank you for allowing me to come on here and just share with your listeners. And listeners, I just want to leave you with this one idea. And I've been very fortunate in my life to, build this passive income, to have the freedom that I have in my life. But ultimately, the one thing that I want you to take away from all of this is that none of it matters, right? If you're not grateful. And so gratitude is the ultimate measure of wealth. Because if you can find gratitude in the simplest things in life, you will be wealthy regardless of what your portfolio is pushing out, regardless of what you have. I mean, if you think about it, we live like kings and queens, even the lowest class, in terms of the lowest salary tax bracket, right? They still live like kings and queens. We have these phones that are freaking computers, supercomputers. And now we're going into the age of AI. So my last, piece of wisdom is just to make sure to remember to be grateful. And that's the ultimate measure of wealth.
Love it, man. No, this is value the perspective and think that this has been an awesome conversation, man. So I wish you a bunch of luck, and thanks again for stopping by.
Appreciate it, Danny. Thank you so much.
All right.